All right. Welcome, future FDIC examiners.
Congratulations
Normal.
on taking this critical step towards earning your commission.
Yeah, this is a big one. You're about to get really familiar with the FDIC's Manual of Examination Policies.
That's right.
The examiner's Bible, you could say.
Think of this deep dive as your crash course in all things examination policies.
It's dense, it's
Help
detailed.
unpack the key concepts.
But trust me, mastering this material
Highlight those mission-critical details and
is essential for ensuring the safety and soundness of our banking system.
make sure you're prepared to hit the ground running when you receive that coveted commission.
Okay, so let's start with the fundamentals. Why does the FDIC even bother examining banks?
Well, it boils down to two primary objectives: maintaining public confidence in the banking system and protecting the Deposit Insurance Fund, or DIF.
Okay,
These are the twin pillars that underpin everything an FDIC examiner does.
that makes sense.
Public confidence.
If people lose faith in banks, the whole system could collapse. And the DIF is there to protect depositors, ensuring they don't lose their hard-earned money if a bank fails.
Precisely, but here's the crucial point. Examinations aren't just about reacting to problems after they occur, they're about proactively
Right.
identifying risks before they escalate into full-blown crises. It's like preventative health care for banks.
So examiners are essentially financial detectives searching for those subtle clues that might signal trouble down the road.
That's a great way to put it, and one of the key tools examiners use to assess a bank's overall health is the CAMELS rating system. That stands for capital adequacy, asset quality, management, earnings, liquidity, and sensitivity to market risk.
Ah, yes, CAMELS.
You got it.
It's one of those acronyms that every examiner needs to have etched into their brain.
Absolutely.
Can you break it down for us? What exactly are examiners looking for within each of those categories?
Absolutely. Let's start with C, capital adequacy. This is all about making sure a bank has enough cushion, enough capital to absorb potential losses without collapsing.
So it's like a financial safety net, ensuring the bank can withstand those unexpected shocks or downturns.
Exactly. Examiners assess the bank's capital levels relative to its risk profile. A bank engaging in riskier activities,
Right.
like lending to highly leveraged borrowers,
Yeah.
would need a larger capital buffer than a more conservative institution.
Makes sense. Now, what about asset quality?
Asset quality focuses on the bank's loans and investments.
Okay.
Examiners scrutinize those assets to determine their overall quality and identify any potential problems like loans that are delinquent or in danger of defaulting.
So they're looking for those red flags that might indicate a deterioration in the bank's loan portfolio.
Precisely, and they pay close attention to the bank's allowance for loan and lease losses, often referred to as all-L.
Okay.
This is the reserve that banks set aside to cover potential losses on their loans.
It's like a rainy day fund, specifically designated for those bad loans that might go sour.
That's a great analogy. Examiners want to make sure that ILL is adequate given the bank's overall loan portfolio and the current economic climate.
Okay, that covers C and A. Let's move on to M, management. This seems like a pretty crucial element, wouldn't you say?
It's absolutely critical. The management component assesses the competence, experience, and integrity of the bank's leadership team, both the board of directors and senior management.
So it's not just about numbers and financial ratios, it's about the people at the helm making sure they're capable of steering the ship.
You got it. Examiners evaluate whether management has a deep understanding of the bank's operations,
Right.
a clear vision for the future, and the ability to identify, measure, monitor, and control the various risks the bank faces.
So they're looking for a strong, well-rounded management team that can navigate those complex challenges that banks inevitably encounter.
Exactly. And a key part of that assessment involves evaluating the bank's internal controls, its audit function, and its overall risk management framework. Are those systems robust enough given the bank's size, complexity, and the types of risks it's taking on?
That's a lot to consider. Okay, let's move on to E, earnings. What's the focus here?
Earnings are the lifeblood of any healthy bank.
Right.
This component examines the quality, consistency, and sustainability of a bank's earnings.
So it's not just about how much a bank is earning, but also how they're earning it. Examiners want to see stable recurring profits derived from core banking activities.
Precisely. Examiners analyze earnings trends looking for red flags like declining profitability or excessive reliance on volatile sources of income.
Okay.
They want to see earnings that can support the bank's operations, maintain adequate capital levels, and absorb potential losses.
Makes sense. What about L, liquidity?
Liquidity is all about a bank's ability to meet its financial obligations as they come due. Can they access sufficient cash and liquid assets to cover those short-term demands like deposit withdrawals or loan commitments?
So it's about ensuring the bank has enough fuel in the tank to keep the engine running smoothly.
Exactly. Examiners assess both the bank's current liquidity position and their prospective liquidity needs,
Right.
taking into account factors like deposit trends, loan growth, and potential market disruptions.
All right, we've covered 5 of the 6 CAMEL's components. Let's wrap up with S, sensitivity to market risk.
This component focuses on how changes in market conditions like interest rates or foreign exchange rates could impact a bank's earnings or capital.
So some banks are more vulnerable to those market swings than others, depending on their business model and the types of assets they hold.
Precisely, a bank with a large portfolio of fixed-rate mortgages would be more sensitive to interest rate increases
Right.
than a bank that focuses on short-term variable rate loans.
Makes sense.
Examiners assess the bank's exposure to various market risks and evaluate how effectively they're measuring, monitoring, and managing those risks.
So it's not just about the level of risk, but also how well they're mitigating it.
Exactly. That's a key theme throughout the entire CAMEL's rating system.
Yeah.
Now, once examiners have assessed each of the CAMEL's components, they assign a rating to each component,
Right.
using a scale of 1 to 5,
Okay.
with 1 being the best and 5 being the worst.
So a bank wants to be aiming for those ones across the board.
You bet. Those ones indicate a bank that's well capitalized with high-quality assets, strong management, healthy earnings, ample liquidity, and minimal sensitivity to market risk. But we'll dive into the specific rating definitions in more detail later on.
Sounds good now to really understand how examiners evaluate banks.
Right.
We need to delve into the UFIR's rating system.
UFR stands for Uniform Financial Institutions Rating System. It's a standardized framework that examiners use to assess the overall condition of a bank,
Okay.
taking into account all those factors we just discussed.
So the CAMEL's ratings are like the individual ingredients, and the UFAR's rating is the final dish.
That's a great analogy. The UFRS uses a composite rating system, also on a scale of 1 to 5, to summarize the bank's overall condition. That composite rating reflects the collective assessment of all those CAMEL's components.
So a bank with strong CAMEL's ratings will generally receive a good composite rating.
Exactly. But it's not as simple. Average examiners use their judgment considering the severity of any weaknesses in those individual components and how those weaknesses might interact to create a greater overall risk.
So there's a lot of nuance and analysis involved. It's not just plugging numbers into a formula.
Absolutely. Now, speaking of the examination process, how often does a bank actually get examined by the FDIC?
That's a great question. From what I understand, most banks undergo a full scope examination every 12 months.
You're right. That's the general rule. But there are exceptions. Well-managed institutions with assets under $3 billion
Okay.
might qualify for an 18-month examination cycle.
So it's like a reward for good behavior and strong risk management practices.
That's a good way to think about it.
Right.
But there are specific criteria that banks need to meet to qualify for that extended cycle. They need to be well capitalized, have received a management component rating of 1 or 2 at their last examination, and have a composite rating of 1 or 2 as well. And of course, they can't be subject to any formal enforcement actions.
So there's a high bar to clear for those banks that want to earn that extra 6 months of breathing room.
Absolutely. And it's crucial to remember that even if a bank qualifies for that 18-month cycle,
Right.
the FDIC always reserves the right to examine more frequently if circumstances warrant it.
It's all about staying vigilant, right?
Right.
Now, speaking of examinations, it's not a one-size-fits-all approach, is it? There are different types of examinations depending on the bank's risk profile and any specific concerns that examiners might have.
You're absolutely right. The FDIC employs a risk-focused approach to supervision,
Okay.
which means tailoring the scope and intensity of examinations to the specific risks posed by each bank.
So let's talk about the different types of examinations. We've got full scope examinations, which, as the name suggests, are the most comprehensive, right?
Exactly. A full scope examination involves a thorough review of all aspects of the bank's operations, including its lending activities, investments, internal controls, compliance with laws and regulations, and of course all those CAMEL's components we discussed earlier.
Okay. And then there are limited scope examinations which focus on specific areas of concern.
Right. A limited scope examination might be triggered by a specific event,
Right.
like a significant change in the bank's lending activities or a deterioration in its asset quality.
Oh.
Or it might be conducted to follow up on issues identified during a previous examination.
So it's a more targeted approach, zeroing in on those areas that pose the greatest risk.
Exactly. And then there are visitations, which are less formal check-ins. These are typically conducted on banks that are considered low risk and have a history of strong performance.
So visitations are like those quick checkups just to make sure everything is still running smoothly.
That's a good way to think about it.
Yeah.
Now, it's important to note that newly chartered institutions and troubled institutions often require more frequent and intensive supervisory oversight,
Right.
regardless of their asset size.
That makes sense. New banks are still finding their footing, and troubled institutions need that extra layer of scrutiny to help them get back on track.
Precisely. Now, let's talk about how examiners go about planning and coordinating these examinations.
Okay.
It's not just a matter of showing up unannounced at the bank's doorstep, right?
Right. There's a lot of behind-the-scenes work that goes into planning an examination. It's a collaborative process
You're absolutely right.
that involves communication and coordination with various parties.
Successful examinations depend on effective collaboration between the FDIC, state banking authorities, other federal agencies, and, of course, the bank's management team.
So who takes the lead in scheduling and coordinating these examinations?
The FDIC typically takes the lead, but we work closely with state banking authorities, especially when it comes to examining state-chartered banks. We also coordinate with other federal agencies like the Federal Reserve or the Office of the Comptroller of the Currency as needed.
And what factors go into determining when an examination is needed?
The scheduling process takes into account a variety of factors, including off-site analysis of the bank's financial data, any red flags or concerns raised by those analyses. Information from other sources like consumer complaints or media reports, and of course the bank's overall risk profile and past examination history.
So there's a lot of information gathering and analysis that happens before examiners even set foot in the bank.
Absolutely. And there are several crucial pre-examination steps that examiners take to prepare.
Okay.
For example, they'll typically contact the bank to request certain documents like board minutes or loan files. They might also review the bank's external audit work papers to get a better understanding of the bank's financial condition.
Okay.
And if the bank has any shared loss agreements in place, examiners will need to understand those agreements and how they might impact the examination process.
So examiners are doing their homework gathering as much information as possible to get a clear picture of the bank's situation before the examination even begins.
Exactly. And once the examination is underway, open communication with the bank's management team is essential.
So it's not about catching the bank out or being adversarial. It's about working collaboratively with them to identify any weaknesses, address any issues, and ultimately ensure they're operating safely and soundly.
Precisely. The examiner in charge, or EIC, will typically have regular meetings with the bank's management team to discuss findings, recommendations, and any corrective actions that might be needed.
It's like a partnership working together to strengthen the bank and protect the interests of depositors.
That's a great way to put it. And for institutions with composite ratings of 3 or worse, or when there are what we call matters requiring board attention, or MRBAs, meetings with the board of directors become particularly important.
So those are the situations where the issues need to be escalated to the highest level of governance within the bank.
Exactly. Now let's talk about another crucial aspect of the examination process: documentation.
Ah, yes, examination work papers. I imagine thorough documentation is essential for every examination.
It's absolutely vital. Examination work papers serve as the official record of the examination process, documenting the examiner's findings, conclusions, and recommendations.
So they're like the evidence that supports the examiner's assessment of the bank.
Precisely. And there are strict guidelines for preparing and maintaining those work papers. They need to be clear, concise, well organized.
Right.
And of course, properly secured to protect confidential information.
Makes sense. And there are specific document retention policies that examiners need to follow.
Absolutely. Examiners must exercise sound judgment in determining which documents to retain and follow established procedures for managing and storing those files, both electronic and paper.
Okay, so we've covered the basic framework of bank examinations.
Right.
But to really master this material, we need to delve into the specifics of the UFERS rating system and those CAMELS component ratings. Are you ready to dive deeper?
Absolutely. Let's unpack those ratings and see what those numbers really mean. All right, let's crack open the UFIRES and explore those composite ratings. These ratings are like a snapshot of a bank's overall health, summarizing the examiner's assessment of all those CAMELS components we discussed earlier.
So it's the big picture view, the overall grade, so to speak.
Exactly. And remember, it's a 1 to 5 scale, with 1 being the best and 5 being, well, the worst possible scenario.
Okay, let's start with the top of the class. Composite 1 institutions. What sets these banks apart?
Composite 1 banks are the gold standard. They're fundamentally sound in every respect, with strong capital levels, high-quality assets, excellent management, healthy earnings, ample liquidity, and minimal sensitivity to market risk.
Wow.
They're like the valedictorians of the banking world, consistently exceeding expectations and demonstrating a rock-solid foundation.
So these are the banks that examiners can sleep soundly at night knowing they're in good hands.
Precisely. They're well-managed,
Yeah.
well-capitalized, and well-positioned to withstand any economic storms that might come their way. And they're in substantial compliance with all applicable laws and regulations.
Now, what about composite 2 institutions? They're still considered fundamentally sound, right?
Absolutely. They're like the honor roll students performing well overall, but maybe with a few minor areas for improvement.
Okay.
Generally, no single CAMELS component rating should be worse than a 3 for a bank to achieve a composite 2 rating.
So they're solid and stable, but might benefit from a bit of fine-tuning in certain areas.
That's a good way to put it. They're not posing any immediate threats to the safety and soundness of the banking system, but examiners will keep a watchful eye on them, monitoring their progress and providing guidance as needed.
Now things start to get a bit more interesting or maybe a bit more concerning when we reach composite 3, right?
That's where the warning bells start to chime a bit louder. Composite 3 institutions are exhibiting some degree of supervisory concern,
Okay.
meaning they have weaknesses that need to be addressed more proactively.
So we're moving from honor roll to needing some extra tutoring.
Yes, and the issues might range from moderate to severe, requiring more than normal supervisory attention typically. However, no single component rating will be worse than a 4 for a bank to receive a composite 3 rating.
So it's not just about the existence of problems, but also about their severity and how effectively management is addressing them.
Exactly. Examiners will be looking for signs that management recognizes those weaknesses, has a plan to correct them, and is taking decisive action.
And if they're not, that's when things can start to spiral.
Right. Composite 3 institutions are more vulnerable to economic downturns or adverse events, and their problems could escalate if they're not addressed promptly and effectively.
And when we get to composite 4, we're talking about institutions that are really in trouble, right?
Yes. At this point, the red flags are waving vigorously. Composite 4 institutions are considered unsafe and unsound, meaning their financial or managerial deficiencies are serious enough to threaten their viability.
So these are the banks that are in danger of failing if they don't turn things around.
That's the harsh reality. And what's even more concerning is that management might not be taking the necessary steps to address those deficiencies, either because they lack the capacity, the resources, or even the willingness to make those tough decisions.
And at this stage, there's a real risk to the deposit insurance fund, right? Because if one of these banks fails, the FDIC might have to step in and cover those insured deposits.
Exactly. That's why supervisory intervention becomes even more critical at this stage. Examiners will likely use a combination of informal and formal enforcement actions to try to nudge those banks back on track.
And finally, we have composite 5, the lowest rating. These are the institutions that are essentially on life support, right?
Unfortunately, yes, these banks are critically deficient in multiple areas, exhibiting extremely unsafe and unsound practices that pose a significant risk to the deposit insurance fund. Their problems are widespread, severe, and often beyond management's ability or willingness to control.
Wow. So their survival is highly unlikely without some form of external intervention like a merger or acquisition.
Right. Failure is often the most likely outcome in these cases, and examiners will be focused on minimizing the loss to the deposit insurance fund and protecting the interests of depositors.
Okay, that's a sobering reality check now that we have good understanding of the composite ratings. Let's break down those individual CAMELS component ratings.
Okay.
Remember, each component receives its own rating on that same 1 to 5 scale, contributing to the overall composite score.
Excellent point. Let's start with C, capital adequacy. A rating of 1 in this category signifies a bank that has a strong capital position relative to its risk profile. They have more than enough capital to absorb potential losses, and they're well positioned to withstand any unexpected shocks to their balance sheet.
So those are the banks with a rock-solid financial foundation. What about a rating of 2?
A 2 rating is still considered satisfactory. It means the bank has adequate capital to support its operations and absorb potential losses, but there might be some minor areas for improvement, perhaps related to the composition or quality of their capital.
So still solid, but maybe with a bit less room for error.
Right now, a 3 rating is where those yellow flags start to appear. It means the bank's capital level isn't quite sufficient to fully support its risk profile, making them more vulnerable to those unexpected downturns.
So they might be meeting the minimum regulatory requirements, but examiners are seeing some vulnerabilities that need to be addressed.
Exactly. And a 4 rating is a clear indication that the bank's capital level is deficient. This is a serious matter, as it suggests the bank might not be able to withstand even moderate losses without jeopardizing its financial stability.
So a 4 rating is a signal that the bank needs to take immediate steps to bolster its capital position, either through retained earnings, raising additional capital from investors, or reducing its risk profile.
Precisely, and a 5 rating is the most dire signaling that the bank's capital level is critically deficient. Their survival is at stake, and they need immediate intervention to avoid collapse.
Okay, let's move on to asset quality.
Mm.
What are the key things examiners are looking for when assessing a bank's asset quality?
Well, as we discussed earlier, asset quality focuses on the bank's loans and investments. A rating of 1 in this category indicates a very healthy loan portfolio with low levels of problem assets and strong credit administration practices.
So those are the banks that are doing a great job of managing their credit risk, carefully vetting borrowers, and ensuring their loans are performing as expected.
Exactly. They have sound underwriting standards, robust loan review processes, and a strong track record of managing those problem assets, whether through collections workouts or charge-offs.
Now, what about a 2 rating? Is that still considered good?
Yes, a 2 rating is still satisfactory. It means the bank's asset quality is generally good, but there might be a few areas that warrant closer attention, perhaps a slight uptick in delinquent loans or some minor weaknesses in their credit administration procedures.
So some room for improvement, but nothing that's setting off any major alarms.
Right now, when we get to a 3 rating, that's when the level of supervisory concern increases. It suggests that the bank's asset quality is deteriorating or that their credit risk management practices are not as strong as they should be.
So examiners might be seeing a higher percentage of problem loans, less stringent underwriting standards, or less effective loan review processes.
Exactly. And that deterioration could be driven by a variety of factors, such as changes in the economy, increased competition, or even internal problems within the bank, like a high turnover rate among loan officers.
And a 4 rating would indicate that the bank is in real trouble asset quality-wise.
Definitely, a 4 rating means those problem assets have reached a significant level and are not being adequately controlled, posing a real threat to the bank's capital and earnings.
So the bank's viability is at risk if they don't take decisive action to clean up those problem assets and strengthen their credit administration practices.
Absolutely. And a 5 re-rating, as you might imagine, is the most dire scenario.
Yeah.
It means the bank's asset quality is critically deficient with a high percentage of non-performing loans, inadequate loan loss reserves, and weak credit risk management practices.
So their loan portfolio is essentially a ticking time bomb that could explode and wipe out their capital.
That's a good way to put it. Okay, let's move on to M. Management. This component is often considered the most subjective and perhaps the most crucial of the CAMELS ratings.
Why is that?
Well, because it's all about assessing the competence, experience, and integrity of the people running the bank, those responsible for making those critical decisions that impact the bank's safety and soundness. A rating of 1 in this category signifies a bank with strong leadership, a clear vision, and a robust risk management culture.
So those are the banks where the board and management are working together, effectively setting clear strategic direction and fostering a culture of compliance and risk awareness.
Exactly. They have a well-defined risk appetite, a comprehensive risk management framework, and strong internal controls to ensure that everyone is following the rules and managing risks appropriately.
Now, what about a 2 rating? Is that still considered good?
Yes, a 2 rating is still satisfactory. It suggests that the bank has a competent management team and adequate risk management practices, but there might be a few minor weaknesses or areas for improvement.
So they're on the right track, but might benefit from some fine-tuning.
Right. Maybe their board isn't quite as engaged as it could be, or their internal audit function could be strengthened.
Now, what about a 3 rating? Is that when the alarm bells start ringing?
Yes, a 3 rating indicates that management's performance needs improvement, or that the bank's risk management practices are not keeping pace with the evolving risks they face.
So maybe they're struggling to keep up with changes in the industry, or they're taking on more risk than they can handle.
That's a possibility, or perhaps their internal controls are weak, leading to compliance issues or operational inefficiencies. At this point, examiners will be looking for signs that management recognizes these shortcomings and is taking steps to address them.
And I imagine a 4 rating is a much more serious matter.
Absolutely. A 4 rating is a red flag that signals deficient leadership or inadequate risk management. These banks are facing significant challenges, and their management team hasn't demonstrated the ability to control the situation.
So there's a real risk that their problems will spiral out of control, potentially leading to even more serious issues like financial losses or regulatory violations.
Exactly. And in some cases, replacing or strengthening the management team might be necessary to turn things around.
And a 5 rating, as with the other components, indicates a critically deficient situation.
Precisely. A 5 rating in management means the bank is in dire straits. Their leadership is either unwilling or unable to address the serious problems facing the institution, putting the bank's very survival in jeopardy.
Okay, so we've covered the first 3 CAMELS components: capital adequacy, asset quality, and management.
Right.
Let's take a deep breath and then delve into the remaining 3 earnings: liquidity and sensitivity to market risk. All right, future examiners, welcome back. We're deep in the weeds of the U4Rs, dissecting those CAMELS ratings. We've tackled capital adequacy, asset quality, and management.
Right.
Now let's move on to the E earnings. I have a feeling this component is all about making sure banks are not just profitable, but also generating those profits in a safe and sustainable way.
You're exactly right. We look beyond just the raw numbers. The bottom line, we're also evaluating the quality, consistency, and sustainability of those earnings.
It's not just about how much money they're making, but also how they're making it.
Precisely. We want to see earnings that are stable, recurring, and derived from the bank's core lending and deposit-taking activities. We're wary of banks that rely heavily on volatile sources of income like trading profits or one-time gains from asset sales. Those can be fleeting and might mask underlying weaknesses in the bank's core business model.
So a bank that's consistently generating solid profits from making sound loans and attracting stable deposits would be viewed favorably.
Absolutely. That indicates a sustainable business model, one that's less likely to be disrupted by changes in the economic environment or market conditions.
Now talk about those earnings ratings. A rating of 1 is the ideal, right? What does that tell us about a bank's earnings performance?
A 1 rating signifies strong, healthy earnings that are more than sufficient to support the bank's operations, maintain capital levels, and absorb potential losses. These banks are firing on all cylinders, financially speaking, and their earnings performance is a key indicator of their overall stability and resilience.
So they're generating enough profits to cover their expenses, invest in growth, and weather any unexpected storms that might come their way.
Exactly. They have a comfortable cushion, so to speak, allowing them to navigate those challenges without jeopardizing their financial stability.
Now, what about a 2 rating? Is that still considered good?
Yes, a 2 rating is still considered satisfactory. The bank's earnings are sufficient to meet their needs, but there might be some minor areas for improvement. Perhaps their profitability is a bit flat, or they're showing some slight vulnerability to changes in interest rates.
So they're in good shape, but might benefit from some fine-tuning. Maybe they need to diversify their revenue streams or improve their expense management.
Right. It's important to remember that even banks with a 2 rating need to be proactive in managing their earnings and ensuring their business model remains sustainable in the long run.
Now, when we move to a 3 rating, that's where those yellow flags start to pop up, right?
Exactly. A 3 rating indicates that the bank's earnings are not quite strong enough to comfortably support their operations, build capital, or cover potential losses. Their profitability might be declining, or their expenses might be growing too quickly. Either way, it's a signal that the bank needs to take a closer look at its earnings performance and identify those areas that need attention.
So they're not in imminent danger, but they're definitely on the watch list.
That's a good way to put it. And if those earnings trends continue to deteriorate, their rating could slip further, putting their financial stability at greater risk.
And a 4 rating means those earnings are deficient, right?
Yeah.
Meaning they're not generating enough profits to cover their costs and maintain their capital levels.
Precisely, a 4 rating is a serious matter, as it suggests the bank might be on the path to unprofitability, and that can erode their capital base, limit their ability to lend, and make them more vulnerable to failure.
So a 4 rating is a real wake-up call for the bank to address its earnings challenges, perhaps, by cutting costs, boosting revenues, or restructuring its operations.
Absolutely. They need to take decisive action to turn things around before those earnings problems become insurmountable.
And a 5 rating, as with the other components, signals a critically deficient situation.
Yes, a 5 rating in earnings is a clear sign that the bank is in deep financial trouble. They're likely experiencing significant losses, and their ability to continue operating as a going concern is seriously in doubt.
Okay, that covers earnings. Let's move on to another critical component. Liquidity. From what I understand, this is all about making sure a bank has enough cash on hand and readily available funds to meet its financial obligations as they come due.
You've got it. Liquidity is essential for any bank, as it enables them to meet those short-term demands like deposit withdrawals, loan commitments, or unexpected expenses without disrupting their operations or jeopardizing their financial stability.
So it's like making sure they have enough fuel in the tank to keep the engine running smoothly both now and in the future.
That's a great analogy. And just like with the other CAMELS components, examiners use a 1 to 5 scale to assess a bank's liquidity position, with 1 being the strongest and 5 being the weakest.
Let's start with the top of the class. Those banks with a 1 rating and liquidity, what sets them apart?
A 1 rating indicates strong liquidity levels and robust funds management practices. These banks have ample sources of funding, both from deposits and other sources, and they can easily convert assets to cash without incurring significant losses.
So they have plenty of options for accessing funds if needed, and they're not overly reliant on any single source of funding.
Exactly, and they also have a well-defined contingency plan, a roadmap for navigating those unexpected liquidity crunches that can arise during times of stress or market turmoil.
Now, what about a 2 rating and liquidity? Is that still considered good?
Yes, a 2 rating is still satisfactory. The bank has access to sufficient liquidity to meet its needs, but there might be a few minor weaknesses in their funds management practices. Perhaps their funding sources aren't as diversified as they could be, or their contingency planning could use some strengthening.
So they're in good shape, but there's always room for improvement, right?
Exactly. And it's important for banks with a 2 rating to be mindful of those vulnerabilities and take steps to bolster their liquidity position.
Now, when we get to a 3 rating, that's when those yellow flags start to wave, right?
Right. A 3 rating in liquidity means the bank's liquidity levels or funds management practices need improvement. They might be facing some constraints in accessing funding, or they might be overly reliant on volatile sources of funds like broker deposits.
So examiners are seeing some cracks in their liquidity armor, so to speak.
Yes, and those cracks could widen if the bank doesn't take action to address those underlying vulnerabilities.
A 4 rating in liquidity means those problems have become more serious, right?
Definitely, a 4 rating signifies deficient liquidity or inadequate funds management. These banks are struggling to meet their obligations, and their access to funding is limited, putting their financial stability at risk.
So a 4 rating is a clear sign that the bank needs to take immediate steps to improve its liquidity position. Perhaps by reducing its reliance on volatile funding sources, strengthening its relationships with other banks, or selling off some of its less liquid assets.
Precisely, they need to act decisively to restore their liquidity and regain the confidence of their creditors and depositors.
And a 5 rating, as you might have guessed, means those liquidity problems are so severe that their very survival is in question.
Right? A 5 rating in liquidity is a dire situation, often indicating that the bank is on the brink of collapse.
Okay, we've covered 5 of the 6 CAMELS components. Let's finish strong with S, sensitivity to market risk. This is all about understanding how changes in market conditions like interest rates, foreign exchange rates, or commodity prices can impact a bank's earnings or capital, right?
Exactly. Some banks are more sensitive to those market fluctuations than others, depending on their business model, the types of assets they hold, and their risk management practices.
So a bank with a large portfolio of fixed-rate mortgages, for example, would be very sensitive to interest rate increases because those higher rates would reduce the value of their mortgage holdings.
Precisely. And a bank that relies heavily on foreign currency transactions would be sensitive to changes in exchange rates because those fluctuations could impact their profitability. Examiners carefully assess a bank's exposure to these various market risks and evaluate how effectively they're measuring, monitoring, and managing those risks.
So it's not just about the level of risk, but also how well they're mitigating it. A bank might have a high level of market risk exposure, but if they have sophisticated risk management systems and hedging strategies in place, that risk might be manageable.
That's exactly right. And those factors are reflected in the sensitivity to market risk ratings. A rating of 1 indicates minimal sensitivity to market fluctuations. These banks have a low-risk profile, their earnings are stable, and they've implemented effective hedging strategies to minimize their exposure to those market swings.
Now, they're weathering those market storms with ease.
Yes, they're well prepared and have a strong track record of managing market risk effectively. Now, a 2 upper rating means the bank has a moderate level of sensitivity to market risk, but is managing it well. They might be exposed to some interest rate or foreign exchange risk, but they have appropriate systems and controls in place to monitor and mitigate those risks.
So they're not immune to market fluctuations, but they're aware of the risks and they're taking the necessary steps to protect themselves.
Exactly. Now, a 3 rating indicates that the bank's sensitivity to market risk is higher and needs closer attention. They might be taking on more risk than they can comfortably handle, or their risk management practices might not be as robust as they should be.
So examiners will be scrutinizing their risk management systems more closely, making sure they have the right policies, procedures, and controls in place to manage those market risks.
Precisely. And a 4 rating means that sensitivity to market risk is a significant concern. These banks are highly exposed to market fluctuations, and their risk management practices are inadequate, leaving them vulnerable to those swings in interest rates, exchange rates, or other market variables.
So a 4 rating is a clear signal that the bank needs to strengthen its risk management framework and reduce its exposure to those volatile market forces.
Absolutely. And a 5 rating, the most severe, means that their exposure to market risk is so high that it poses an imminent threat to their survival.
Okay, we've covered all 6 CAMELS components and their respective ratings. It's remarkable how much detail goes into evaluating a bank's health and performance. But the system makes sense. It's thorough, it's comprehensive, and it's designed to ensure the stability of our banking system.
That's precisely right. The CAMELS rating system and the U4's framework are powerful tools that help examiners identify those potential problems early on, assess the severity of those issues, and take the necessary steps to protect depositors and maintain public confidence in our banks.
So, future examiners, you've absorbed a lot of information. Now, let's put that knowledge to the test with a little pop quiz ready.
Bring it on.
All right, first question. What are the 2 primary objectives of the FDIC's bank examination process?
That's an easy one, maintaining public confidence in the banking system and protecting the Deposit Insurance Fund.
Excellent. Now for a slightly tougher one. Can you name the 6 components of the CAMELS rating system?
Of course, capital adequacy, asset quality, management earnings, liquidity, and sensitivity to market risk.
You aced it now for a real brain teaser. What's the most important thing for examiners to remember when assessing a bank's management component?
That's a great question. I'd say the most important thing is to look beyond the numbers and assess the competence, experience, and integrity of the people running the bank. Do they have a deep understanding of the bank's operations, a clear vision for the future, and a strong commitment to risk management and compliance? Those are the qualities that truly differentiate strong management teams from those that are struggling to keep up.
Excellent answer. You've clearly grasped the core concepts here. Now for our final question. What's the key takeaway you want our future examiners to remember from this deep dive into the UFARs and the CAMELS rating system?
I would say these frameworks are not just about checklists and regulations. They're about understanding the complexities of banking, identifying those early warning signs of trouble, and taking decisive action to protect the financial system and the interests of depositors. Your role as an examiner is critical, and your judgment, your insights, and your commitment to safety and soundness will make a real difference.
Well said. And remember, future examiners, this is just the beginning of your journey. The real learning starts when you step into the field, apply these concepts in real-world scenarios, and use your judgment to navigate the ever-changing complexities of the banking industry.
We have no doubt you'll do great things. Best of luck out there.
That's a wrap for this deep dive. Until next time, keep exploring, keep learning, and keep those brains buzzing.